Altria Group, ticker MO, is a company loved by dividend investors mainly because of its high and steady dividend yield of 7.54%. Now, year to date, the company is up by 30%. And so today we will figure out if MO is a buy at its current trading price by calculating its intrinsic value using our 4 valuation models. We will also have a look at its fundamentals using our 9-pillar analysis. Now, first of all, let's jump back to the stock screener and have a look at the trailing free cash flow payout ratio of the company, which is sitting at almost 80%. Now, with Altria Group, I don't really mind as they push almost none of their free cash flow into innovation. So the 20% they have left after paying out their dividend should be enough to buy back shares, raise that dividend, and pay off debt. And talking about debt, if we direct our attention to the market cap, we can see that is sitting at 92 billion, while the enterprise value is sitting at 115 billion. And this is a very simple way to tell how much debt a company has, because essentially the difference between the market cap and the enterprise value is the debt of the company. So we can see that Altria does have quite a bit of debt, but we will look into that a bit further in the video. Now, jumping straight to the 9-pillar analysis, we can see that they get a rating of 7 out of 9 with only 2 pillars in the red. Now, first let's have a look at how expensive Altria is trading. Their average 5-year P ratio is sitting at 19.12, which is well in the range we like to see. If we have a closer look, we can see that currently that is sitting even lower at only 9.14, which means that investors pay only $9 for $1 of Altria's earnings, which would be considered undervalued. Now let's also have a look at their price to free cash flow, which is essentially the same thing as price to earnings, except we have a look at the free cash flow of the company. And on average over the past 5 years, this was sitting at 11.54. Now, if again we have a closer look, we can see that currently that is sitting even lower, and Altria has actually been lowering it quite decently over the past 5 years, as we can see on the graph as well, at a rate of about 6.84% yearly. And so that's something I love about the company. They are currently undervalued compared to their earnings and compared to their free cash flow. But now let's have a look at the growth of the company. And I don't really expect Altria to have grown much and to grow much into the future, as they are in the tobacco sector. And specifically, that sector doesn't have too much growth to it. So if we have a look at the revenue growth, we can see that on average it has been increasing by 0.60% yearly over the past 5 years, which isn't much at all. The free cash flow has been increasing by about 4.77% yearly, and the net income seems to have been falling. So let's have a look at that. Let's check out the net income a little closer. We can see that it did rise from 2019 to 2020 by a lot, and that is why the percentage is negative. But overall, it has been increasing very nicely from 2021 to the current time, and year over year it actually increased by another 26.5%. So Altria has great growth in the net income. Now, regarding their free cash flow growth, that hasn't been growing as well as the net income, but it has been growing very steadily at a rate of almost 5% yearly. So Altria is growing at a higher rate than what I expected, but that of course is a pleasant surprise. And now let's have a look at some of the remaining pillars. So Altria has been decreasing their shares outstanding at a rate of 1.45% yearly, which I very much like, as by buying back shares, the company increases the value of the leftover shares outstanding. And of course, who wouldn't want their shares to have more value? They also have a 5-year profit margin sitting at 66.61%, which is well in the range we like to see. And if we have a closer look, we can see that that actually has been rising over the past 5 years, which I very much like, showing me that Altria is becoming more and more profitable. We can see that it rose from 64% in 2019, very steadily rising to about 69% in 2023, and currently is sitting even higher than in 2023. So Altria is doing a great job becoming more profitable, which I very much love. Now let's have a look at the debt to free cash flow ratio pillar, which is the only pillar that quite concerns me regarding Altria. In this pillar, we have a look at the long-term liabilities over the 5-year free cash flow negative dividends, which tells us if the company generates enough free cash flow to pay down their debt while paying out their current dividend. And ideally, this ratio should be below 3. And we can see for Altria, this is sitting at 13.56, which means that they would take more than 50 years to pay off all their long-term liabilities while paying out their current dividend with the free cash flow they generate. Now, if we jump closer, we can see that they do currently have quite a lot of long-term liabilities, and that is what I talked about at the start. They do have some debt. Long-term liabilities are essentially debt. Now we can see that they have been lowering their long-term liabilities, which I obviously like, but still, with the free cash flow they currently generate and with the dividend they are currently paying out, it would take them a lot of time to pay down all their long-term liabilities. But as Altria is in the tobacco sector, which doesn't fluctuate that much, and with the population increasing, there will always be a demand for tobacco, for cigarettes, and for cigars. And so I do believe that Altria will very steadily keep growing their free cash flow as well as net income, eventually lowering this ratio. So thanks to Altria being in such a non-volatile sector, this high ratio doesn't bother me as much as it would with some other companies. And finally, let's have a look at the consecutive dividend growth, which is sitting at 3.84% yearly over the past 5 years. And if we jump a little closer, this dividend growth is below the average, but Altria makes up for that with a very high dividend yield of 7.54%. So overall, Altria is looking very well. They look to be undervalued. They have quite decent growth for the tobacco sector, and they have a growing 5-year profit margin, which is great. The only thing that could be better is the long-term liabilities to the 5-year free cash flow ratio. But anyway, let's now calculate their intrinsic value, first using the Grams formula revised. And here to calculate the intrinsic value, we have to predict the earnings per share growth. So I predict the high earnings per share growth at 6%, medium at 5%, and low at 4%. I then average this out with the analyst predictions and get an earnings growth estimate of 4.35% yearly over the next 5 years. I then take all of these 5 values and plugging them into the Grams formula, we get an intrinsic value of $41.88, which is 28% lower than the current trading price. Now jumping to the second valuation model, the discounted cash flow model, I plug in the free cash flow over the past 5 years and calculate an average growth rate of 4.77%. I then calculate a growth rate into the future, so into the next 10 years plus of 3.7%, and using this I calculate the future free cash flow. After that, I plug in a discount rate at 9.7%, which is essentially the minimum rate of return I want from an investment into Altria, and using this discount rate, I calculate the present value of that future free cash flow. I then sum all of that up, add cash and cash equivalents, and subtract total debt, and that gives me an equity value, which I divide by the shares outstanding and get an intrinsic value of $80.69, which is higher than the current trading price. Now for the multiples valuation, we want to compare MO to two of its competitors, so Japan Tobacco and Imperial Tobacco Group. We take these companies' current stock prices and divide by their earnings per share to get their current PE ratios. We then average out these PE ratios and multiply by the earnings per share of MO to get its intrinsic value of $70.83, again quite higher than the current trading price. Now for the final valuation model, we want to have a look at the dividend growth of MO. So we take the dividend payouts and the dividend growth over the past 5 years and calculate the average growth rate to be sitting at 4.02%. Now as I do want to be conservative, I project a growth rate of 3.67% into the future, and that gives me an intrinsic value of $66.15. And finally, when we average out these four valuation models, we get an ultimate intrinsic value of $64.89, which is 20.66% higher than the current trading price. And with a margin of safety of 10%, we would get an acceptable buy price at $58.40. And with that, I hope that you found the video helpful. Make sure to leave a like and subscribe, as it really helps me out.